Footlocker shares have declined year to date on the back of Nike's decision to continue to surge ahead with their direct-to-consumer selling strategy. But has the share price decline in Footlocker been overdone? And are the shares in value territory? That's what we're going to dive into in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel where the goal here is to help 1,000 people achieve financial freedom much sooner. And let's dive right into this story, which is a couple months old now. So you can see here, in late February, Footlocker shares actually dropped 36% on the back of news that Nike would account for less of the total sales of Footlocker in 2022. So they would account for 60%, which is down from 70% in the prior year and down from 75% in 2020. And so you can see here that Footlocker shares year to date are now down 33% on this news. So they really never recovered from that late February decline. And so the real question is, will Footlocker be a competitive retailer on the back of fewer Nike shoes on its shelves? And you can see here that Footlocker actually did say that the sharply reduced allocations from Nike would lead to same-store sales declines between 8 and 10% in 2022. Footlocker expects Nike to supply about 55% of its sales by the fourth quarter of 2022 and continue at that level into 2023. And so, of course, fewer Nike shoes means fewer Nike sales for Footlocker. And this just continues a trend of Nike selling more and more shoes to the consumer. So you can see here that the Nike's direct-to-consumer sales as a percentage of total brand revenue has more than doubled over the last 10 or so years. And so Dick Johnson, Footlocker CEO, said that Nike will remain an important partner for their business, especially in basketball, kids, and sneaker culture. However, the big blow will be the reduced allocations of high demand products such as retro Air Jordans and LeBron James signature shoes. They'll still have access, they'll just see fewer units in those SKUs. So of course, fewer units in those SKUs means fewer sales. More of those sales are going to be going to Nike themselves. And so they're going to have to adjust for this by increasing their allocations in Adidas, Puma, New Balance, Timberlands, Uggs, Reeboks, Crocs, and other brands. So they're essentially changing their strategy to becoming a true house of brands as opposed to more specifically Nike tailored. And in addition to just being a house of brands for sneakers, you can see here that Footlocker is expected to also increase their investments in apparel and private label offerings while accelerating its expansions of larger off-mall stores and continuing to make acquisitions. But what really scares me here is Footlocker falling behind? That's the real question. Because why is Nike really moving towards a more direct-to-consumer strategy in the first place? Well, you can see here, more than half of all athletic footwear purchases are now being made online, and that share is only increasing. So, is Footlocker in the wrong place by being a brick-and-mortar retailer as the market is declining and you have this sort of secular decline? And so essentially what's happening is you don't necessarily have the recovery that Footlocker is expecting to generate by being a house of brands, because once you lose those brands and they start selling more online, it conditions the customer to purchase more and more shoes online. Now look, I'm just thinking about my own behavior. I didn't even realize that the last 4 or 5 purchases of shoes that I did make were actually online. It's just a natural progression to buy shoes online. You don't necessarily have to try them out, especially if you're in a situation where you can return the shoes if they just don't fit properly. So you can see here that I did state that a strategy modification does equal more risk. There was a CEO that made a suggestion of going direct to consumer themselves, and Zach Zalowitz, who happens to be the VP of Digital Technology at Footlocker, albeit he is new, but he is a VP of Digital Technology at Footlocker, is saying that the Crocs isn't a good idea, and it looks like they already have their own direct-to-consumer brand. Direct-to-consumer works best when the brand pulls the customer online. So Nike is one of those types of brands that can do that. I don't know if a house brand for Footlocker can have the same type of pull. Now, I do want to show you the valuation for Footlocker, and I want to explain that the Patreons have full access to the whole model, but I don't want you to be confused, because you can see here that although the share price today is around $30 per share and the intrinsic value is around $60 per share, so the share price as a percentage of its intrinsic value is lower than 50%, and they have no debt, which is really good. I do want to point out that there are risks in this business. One, it's not an inflation resistant business. And two, there is a very small economic moat, especially as you become a house of brands and you just start selling a bunch of various brands. So, how are you any different from any other sneaker retailer at this point? And so, I would caution you here that this could potentially be a value trap because Footlocker has two issues. One, there's that potential secular decline where more and more retail sales of sneakers are going online. And two, going forward, there might not necessarily be anything that keeps Footlocker unique from other shoe retailers. And you can see here, this is the model that the Patreons have access to. You can see that even with a greater allocation of Nike shoes, their top line revenue hasn't necessarily grown that much year over year for the past 10 years. So overall, the retailer hasn't necessarily been excelling on their own. And you can see in my valuation for Footlocker, I'm actually forecasting a decline for 2023, a decline for 2024, and no growth for 2025, and a slight recovery in 2026 and beyond. And with that, with a 15 times terminal multiple, which is the pre-COVID average, you can see that I'm getting to an EPS valuation of $60 per share. However, I don't think I'm a buyer at $30 per share. At the very least, I would have to sell sort of like a cash secured put to buy it at maybe like $20 a share. But that's because I'm very risk averse and I'm really concerned about further downside risk here. But you can see that the current share price reflects an 8.4 times multiple. So that might be enough of a discount for most value investors to buy in at this point. Now, of course, you can get access to the Footlocker model at the $5 per month Patreon subscription. And of course, you guys already know that if you decide to try out the Patreon and you don't like it, you can actually send me a message in the Patreon and say, hey, Tay, I tried it and it wasn't for me, and I'll fully refund your first month's subscription in that month. So there's no risk to you. Now, moving on, I did take a look at the cash secured puts. The $25 cash secured put, you can get at approximately $3 of a premium. So that's interesting. And then here's something that the Patreons do get access to. This is called the cash secured put analysis tool. So if you insert that $25 cash secured put at the $3 premium, you see that you get a put yield of 16%. So that's pretty decent. And you also get a net purchase price of $22 per share. So worst case scenario, if you do get exercised on this put, you are effectively purchasing it at 6 times earnings. So I think that's a decent enough valuation where most value investors can get in. So for those of you who think that the current share price is fine, by all means, you can buy it at under 50% of what its intrinsic value is. For those of you like myself who want more of a downside protection, well, the cash secured puts are offering that opportunity. So I think there's something for everyone here. And then, of course, if you just don't want to take the risk because it's not a spectacular retailer and there's additional risk, I would say just stay away from it. So something for everyone here. Now, speaking of a strong brand, my next video, I'm going to be talking about Nike and doing a full valuation on them because I find it interesting that they're changing their strategy. And I think this is a strategy that's working. So I want to know what Nike is valued at and is it selling for a deep enough discount from its intrinsic value. So if you haven't done so already, please consider subscribing to the channel and hitting that notification bell so you don't miss that video. Also, if you're looking for an exceptionally strong brand, Twitter absolutely owns the microblogging space. Nobody comes even close. And I think that there is an arbitrage opportunity if you can stomach the potential Elon Musk risk that a lot of people are identifying. And I made a video on that, which you can get to right here.